Due diligence is one of the most overused and least understood phrases in property. Let's actually define what it means and what it requires. I want to start with a question. If I asked you right now to define due diligence in the context of a property purchase, what would you say? Most people would say something like pest and building inspection, maybe a title search, check the strata if it's an apartment. That's not wrong. But if that's where your definition stops, you're covering perhaps 10% of the actual risk surface of a property acquisition. The rest of it, the market level analysis, the portfolio level thinking, the long horizon risk assessment doesn't get labeled as due diligence in most property buyers' mental models. But it's the difference between an asset you can hold confidently through cycles and an asset that reveals its problems incrementally over the following years. So, in this video, I want to give you a complete, structured framework for due diligence as we practice it at OV Property Buyers and explain why each level matters and what it's actually protecting you against. Before we go any further, a little bit about me. My name is Vijay Kamle, and I run a buyers agency based out of Sydney, helping investors buy properties across Australia using a structured framework anchored in data. With that out of the way, let's start with level one, asset level due diligence. This is the baseline, and it's non negotiable. For every property we bring to a client as a genuine candidate, the asset level assessment includes building inspection, not just the report, but a genuine understanding of what the building inspector found and what it means for maintenance trajectory. Pest inspection, same principle. The report is a starting point for understanding the condition of the asset and what the likely capital expenditure profile looks like over the next 5 to 10 years. A well maintained property with minor issues is a different investment proposition to a property with significant deferred maintenance, regardless of what the purchase price looks like. We won't be talking about strata reports only because our agency does not buy units. Next is title search. We confirm clean title, understand any encumbrances, and identify any matters that could complicate future sale or development. Next is council overlay review. We check what zoning applies, whether there are any heritage overlays, flooding or bushfire risks, easements, and whether there are any negative caveats that could affect the property's use or value. A lot of buyers look at a property and ask, is it a good property? The asset level due diligence is asking a different question. What does this property's physical and legal position actually mean for my risk exposure? They are related, but not the same question. Now let's talk about level two, market level due diligence. This is where the depth of analysis separates disciplined buyers from the rest of the market. Market level due diligence is asking, what is the demand picture for this property type in this location, and is it structurally supported or cyclically dependent? Let's break that down. On the demand side, what's the rental market depth for this specific dwelling type at this price point in this suburb? Not the city, not the region, the suburb, and ideally the specific pocket within it. Depth means the number of potential tenants competing for this type of property. A deeper rental market means lower vacancy risk, more consistent rental income, and more pricing power in tenant negotiations. On the vacancy rate, what's the current rate? What's the trend? And critically, is there a seasonal element to it? Understanding the full profile rather than just the current snapshot gives you a more accurate picture of average vacancy over a full year. On the supply pipeline, what new dwellings of a similar type are approved, under construction, or likely to be developed in this market over the next 2 to 3 years? A strong current market can absorb a limited new supply without significant impact, but a significant supply addition relative to the tenant pool can meaningfully change the rental equilibrium and the price growth trajectory in ways that weren't visible at the point of purchase. Moving on to the employment base. What are the dominant industries in this market? How diversified is the employment profile? And what's the trajectory? An employment base concentrated in a single industry, resources, tourism, defense, creates cyclical demand that can look like structural demand until the cycle turns. The structural demand comes from diversified employment that's relatively resilient to individual sector disruptions. On the infrastructure pipeline, What government investment is committed or likely in the transport, education, and health infrastructure serving this location? Infrastructure investment doesn't guarantee price growth. The relationship is more complex than that, but it can be a meaningful indicator of future connectivity and amenity that affects the location's long term appeal to both tenants and future buyers. At OV Property Buyers, this is the level of analysis we do on every market before we'll consider bringing property from it to a client brief. It's time intensive and it requires access to data that's not all publicly available. If you're looking for help with your next purchase, reach out via the discovery call link in the description. Let's move on to the level 3 due diligence, portfolio level due diligence. This level is about the acquisition, not in isolation, but in the context of what you already own and where you're trying to get to. The question here is, what does adding this specific asset do to my overall portfolio position? Does it improve my diversification by geography, by property type, by cash flow profile, or does it concentrate risk I already have? If you already own a house in a major East Coast capital, buying another house in a similar market adds geographic concentration. That's not automatically wrong, but it's a deliberate choice that should be made consciously, not by default. If your existing portfolio is weighted toward capital growth with thin cash flow, adding another growth asset extends your dependence on continued equity appreciation. If you hit a flat period, the cash flow demands of multiple growth assets can become a strain. A yield heavy asset might improve the portfolio's resilience even if it's not the highest performing asset on a pure capital growth basis. Portfolio level due diligence also asks, what does this acquisition do to my serviceability position for future purchases? If this purchase consumes borrowing capacity that I had planned to use for a different asset in, say, 18 months, is that the right sequencing decision? These aren't exotic questions. They are the questions that distinguish investors who build coherent portfolios from investors who accumulate a collection of individual property that don't add up to a deliberate whole. Let me also address a practical reality. Doing due diligence properly takes time. It's not a half day exercise. A full 3 level assessment, asset, market, and portfolio typically takes us days per genuine candidate. That's the honest timeline when you're doing it rigorously. For a self directed buyer with a full time job and a family commitment, that's a meaningful time commitment per property across however many properties you evaluate before making a purchase. It's one of the practical reasons that professional buyers agency even exist. Not because buyers aren't capable of this analysis, but because the time it takes to do it well is genuinely significant. And most people's bandwidth is limited. Wherever you sit on the spectrum of doing it yourself versus engaging professional support like a bias agency like ours, the key point is this: due diligence is not a formality. It's the primary mechanism you have for reducing the probability of a bad outcome before you commit capital. The time you invest in it is almost always worth it.